It's Wealth Redux and I'm your friendly wealth manager revealing the secrets of the ultra-wealthy. If you find any of this useful, please like and subscribe. Have you ever wondered how the wealthy avoid capital gains taxes? Well, to understand that we first need to comprehend what capital gains tax is. Imagine it as a toll you pay when you sell an asset for more than you paid for it. This could be anything from stocks and bonds to real estate and businesses. The difference between your purchase price and the price you sell it for is your capital gain. Now the government wants a piece of that pie, and that's where capital gains tax comes in. It's a levy on the profit you make from selling these assets. Essentially, the more profit you make, the more tax you end up paying. This can significantly affect an individual's wealth, especially when dealing with high-value assets. But what if there was a way to avoid this tax legally? Intrigued? Let's dive in. Enter the borrow and die strategy, a method the wealthy use to bypass capital gains tax. This strategy sounds morbid, but it's a simple, albeit shrewd financial maneuver that the affluent utilize to preserve their wealth. So, what exactly is the borrow and die strategy? In essence, this strategy involves borrowing against one's assets, instead of selling them. When you sell an asset that is appreciated in value, such as a stock or real estate, you usually have to pay capital gains tax on the profit you've made. This tax can take a significant chunk out of your profits, especially if you fall into one of the higher tax brackets. But the borrow and die strategy circumvents this tax. Here's how it works. Instead of selling their assets, the wealthy borrow against them. They use these assets as collateral to secure loans, and since loans aren't considered income, they're not subject to tax. Essentially, the wealthy are able to access the value of their assets without having to sell them and incur a tax liability. Now, you might be wondering, what about the interest on these loans? Well, that's another clever aspect of this strategy. The interest on margin loans, that is, loans used to buy or carry securities, can be tax deductible if the borrower itemizes their taxes. So, not only do the wealthy avoid capital gains tax, they can potentially reduce their taxable income even further. But here's the real kicker, the die part of the borrow and die strategy. When the asset owner passes away, the assets get a step up in basis. This means that the asset's value for tax purposes is reset to its market value at the time of the owner's death. Any loans against the asset can be paid off by the heirs by selling the asset, and no capital gains tax is due because of the stepped-up basis. So how does this work in practice? Let's break it down. Scene script. Imagine you're a wealthy individual with a host of assets. You don't want to sell these assets and incur capital gains tax. What do? Well, you could employ the borrow and die strategy, a method that's as intriguing as its name. Let's break it down, step by step. To begin, let's say you're a well-off person, flush with assets that have significantly appreciated over time. You could sell these assets, but doing so would trigger a capital gains tax event, and that's a hefty bill you'd rather avoid. So instead you decide to borrow against these assets. Step 1 is to take out a loan, using your valuable assets as collateral. You might be wondering, isn't the loan considered income, thus taxable? In fact, it's not. The IRS does not regard borrowed money as income because there's an obligation to pay it back. So, you obtain liquid cash without triggering a tax event. Now, you're sitting on a pile of cash that's free from immediate taxation. But there's a catch, you have to pay back that loan, which brings us to step 2. You use the income generated by your assets to service the debt. Let's say your assets are stocks that pay dividends, or properties that yield rental income. This income can be used to pay the interest on your loan, and over time, even repay the principal. But wait, there's more. If you itemize your taxes, you can also deduct the interest on this loan. Yes, you heard that right. The interest you're paying on the loan taken against your assets can be deducted from your taxable income, lowering your overall tax liability. It's like having your cake, eating it too, and then getting a tax break on the cake. Now you might be thinking, but won't I eventually have to sell the assets to fully repay the loan? And this is where the die part of the borrow and die strategy comes into play. You see, the goal is to never sell the assets. Instead, you hold on to them until, well, you pass away. On your demise, these assets get a step up in basis for your heirs. This means the value of the assets is recalculated as of the date of your death, not when you initially acquired them. And what happens to the loan? Well, your heirs can continue the strategy, using the stepped-up assets as collateral for a new loan to pay off the old one. This way, the assets are never sold, the capital gains tax is never triggered, and the cycle can continue. Remember, this is a simplified explanation of a complex strategy that involves numerous tax and legal considerations. It's critical to seek the advice of a qualified financial advisor or tax professional before choosing this or any strategy. So, in essence, the borrow and die strategy is about using loans to unlock the value of your assets without triggering a capital gains tax event. You borrow against your assets, use the income they generate to service the debt, and then, well, you simply keep the assets until you pass away. And then, well, you simply keep the assets until you pass away. The last step of the borrow and die strategy might sound morbid, but it's crucial to its effectiveness. This is where things get really interesting. You see, after the wealthy individual has borrowed against their highly appreciated assets, lived a life of luxury and then passed away, the assets are transferred to their heirs. But what about the taxes? Here's the kicker. The assets are subject to something called the step-up in basis rule. This is an important element of tax law that's often overlooked. Here's how it works. The cost basis of the assets, which is essentially the original price paid for them, is reset to their market value at the time of death. Let's say, for example, our wealthy individual bought a share of stock for $100 decades ago. Over the years, the value of that stock has skyrocketed to $10,000. Normally, if sold, the capital gains tax would be due on the $9,900 gain. But with the step-up in basis rule, the cost basis is reset to $10,000 at the time of death. So, if the heirs sell the stock for $10,000, there's no gain, and hence, no capital gains tax. This rule effectively erases any potential capital gains tax liability. So, the loan that was taken out against the assets? It's paid off by selling a portion of the assets, tax-free, thanks to the step-up in basis rule. And the remaining assets, they're passed on to the heirs, also tax-free. This strategy, as you can see, allows wealthy individuals to enjoy their wealth during their lifetime, without worrying about capital gains tax. Then, upon their death, their heirs receive the remaining assets without the burden of a hefty tax bill. It's a win-win situation for the wealthy and their heirs, thanks to some clever financial planning and a deep understanding of tax law. So, the borrow and die strategy allows the wealthy to avoid capital gains tax during their lifetime and potentially eliminate it for their heirs. The borrow and die strategy is a tax-efficient way for the wealthy to manage their assets. This elegant financial maneuver involves borrowing against appreciating assets rather than selling them to avoid capital gains taxes. Upon death, these assets receive a stepped-up basis, effectively erasing the capital gain for heirs, who inherit debt-free. The implications of this strategy are as fascinating as they are controversial. On one hand, it's a savvy tax avoidance technique that perpetuates wealth across generations. On the other, it exacerbates wealth inequality, as it's largely inaccessible to those outside the world of affluence. It also poses significant questions about the fairness of our tax system, as it allows the wealthy to sidestep taxes that others must pay. While it's a clever strategy, it's not without controversy. But that's a discussion for another time. For now, you're a little wiser about the tax strategies of the wealthy. This is Confessions of a Wealth Manager, and if you found this useful, please like, share, and subscribe.